The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, everybody. My name is Greg Newman. I'm Corporate Communications Manager for World Council of Credit Unions, and welcome to our webinar on the global economic impact of COVID-19 on credit unions. I'm joined today by Andrew Price. He's our Senior Vice President of Advocacy at World Council, by Brian Branch, our President and CEO, and also by Sohini Chowdhury. She is the Director and a Senior Economist at Moodys Analytics. And we're going to start this webinar today with a few words from Brian Branch. But before that, I just want to let everybody know that is on the webinar right now that all attendees are muted upon entry. So if you have any questions while you're watching the webinar from the presenters, there's a question panel that you'll see on your screen on the right-hand side. And if you drop that down, you'll be able to ask a question there, and all of those questions that you put in that space are going to be answered by one of our presenters at the end of this webinar after the final presentation. And just to let you know as well, the webinar is being recorded, so it's going to be available later today on the World Council YouTube channel. That's youtube.com/WOCCU, W-O-C-C-U. So we're going to start with a few words from our President and CEO, Brian Branch, who's going to talk to us about the three waves facing the international credit union movement during the time of COVID-19. Brian?
Thanks, Greg. And we've talked about three waves impacting the credit union system globally around the world as we deal through this crisis. In a number of countries, credit union members are sick or to work, they're economically fragile, financially significantly by health costs, and now in many cases our members are laid off. So that's affected to generate income, to make their loan payments. They've had to withdraw their savings, and we're beginning to see many of our members start to lose their assets, not just their savings, their retirement investments, but also their hard assets such as their housing or their vehicles. So everywhere around the world, we see and try to help mitigate that impact on their members, helping them with loan restructuring, deferred payments, reduced interest rate, and extensions to provide members with the flexibility to help them get through that crisis. We introduce new products, advances, low interest loans, or non-interest loans to help their members get through the crisis. And all of this has a financial impact on our institutions. So the first wave that we talk about is the health crisis and the impact that has on our members. Now, as our institutions help their members get through that crisis, there's impact on that. And there's also the ensuing negative impacts of increased delinquency. Members are not able to repay their loans, and decreased loan portfolio income with increased provision costs the credit unions have to face, and decreased liquidity as loans default, as members withdraw their savings, and as we've seen in a number of countries, as banks begin to limit the ability of credit unions to withdraw their funds in bank accounts. So the result, this second wave, the institutional stress that we see on our institutions, is the financial impact of these external factors, and also the commitment that our institutions have to help their members. So we're going to see, as a result of this, well through the second, third, fourth quarter of 2020, the institutional stress, slower growth, higher provision costs, and reduced capital position, reduced capital reserves. So that's why most of the credit unions that we're talking to today around the world are talking about their focus on cash flow management, liquidity management. They're spending a lot of time working with their staff in terms of proper ways for flexible restructuring loan implementation, how to manage, how to analyze those non-performing loans, and dealing with their regulatory constraints in terms of how to provision those, under what conditions they can work with members, restructure payments, and move towards collections at some point in the future. The biggest challenge that we're hearing today from most credit unions is the impact on their capital reserves and their need to do business financial planning to deal with that. Well, the third wave follows the second wave. And the third wave is the global recession. So as value chains have been disrupted, as international commerce has been disrupted, local economies have been disrupted with stay-at-home, then again, we see the impact on our members. It's unemployment, losing their assets, not able to generate income, not able to repay their loans. And so we see significant disruption in their communities. And again, we see the same types of impact on the credit unions that I talked about when I talked about institutional stress. So there's a continued danger of losses in the loan portfolio, of drawing down reserves, and in many cases, for smaller institutions, this is a serious capital impairment danger. And so that's why many of the credit unions today, in trying to prepare for this recession that is upon us, and we will see this through the third, fourth quarter of 2020 and through 2021, credit unions are going to be very focused on asset recovery management, rebuilding their reserves, and how to support increased capital. The great irony and one of the great strengths of the credit union system around the world is that we've been through crises like this before. We've been through recessions. And what we will see happening is that members will start bringing their savings to the credit unions. They want a safe place that they know they can put their savings at in their community. We'll see liquidity start to increase. And we're also seeing, currently actually, we're also hearing from a number of credit unions around the world that as small businesses are coming out of stay-at-home orders and lockdown orders, and they're looking to re-engage their business and start up, they're finding it very difficult to access financing from some of the more formal financial institutions out there. And they're increasingly turning to credit unions for financing for their small business, for their small production activities. And so this is a great opportunity for credit unions to provide that valued service to their members to help them out of their difficulties, and in the long run generates that loyalty and that increased service, membership growth, and savings growth for credit unions in the future. So thanks for the opportunity to visit with you, and I'll turn it back to you, Greg.
Okay, thanks a lot, Brian. Brian's been giving that presentation to a number of credit union associations around the world, and we're always appreciative of him doing that. Up now is Sohini Chowdhury. She's our featured panelist today and our featured presenter. Sohini is Director and Senior Economist at Moodys Analytics. And she, I know, is why a lot of you are here to watch us today. So she's going to talk a little bit about how Moody's is viewing this and the impact that COVID-19 is having on credit unions. Sohini.
Thank you, Greg. Thanks, Greg and Brian. Welcome everyone today to the webinar, and I'll start off by dovetailing off the third wave that Brian discussed. Next slide, Andy. And we are indeed in a global recession, and at this point we can see what is going on. It's sort of like the bloodbath going on across the world, and no country is spared. Every country, so you can see this map of the world. The economies in red are expected to suffer a recession in 2020. So this is our estimate based on our forecasting models. So every continent is facing, a recession. The exact definition of a recession differs country to country, because as you know, developing countries are, in normal cases, they have a very high growth rate relative to more mature developed countries. But every country is expected to suffer a recession this year. Next slide. And so I look a bit deeper into this and try to differentiate, between the different continents. And the bars that I'm showing here are real GDP growth over that particular calendar quarter growth rate from the previous year. So take a look at the orange bars right here. So globally, GDP growth in 2020, which is still a forecast because we are just in the middle of the year, is expected to be negative for across the world. So not just for the world as a whole, but North America, South America, every continent. And the dark blue and green bars are GDP growth that we had in the last 2 years. So as an example, you can see Asia had the best GDP growth going into the crisis. The opposite is true of South America, where the countries, they had their own economic issues to begin with. So they had like almost negligible growth in 2018 and 19. But whether you were growing faster or slower, doesn't matter. Come the coronavirus, and then the orange bars are negative across the board. The good thing is in 2021 and 2022, our forecast of GDP growth is positive for each of these regions. So that's good, but it'll be a while before we get there. And the rest of the presentation will detail some of the challenges that we are going to face this year. Next slide. So this chart is interesting because it is showing global GDP growth by forecast vintage. So it's showing how quickly our outlook for GDP growth has deteriorated, starting from the dark blue line, which is January. So Moody's Analytics, we published our baseline forecast early January, which is sort of based on historical data ending end of December. So the world at that point looked pretty good, and we were projecting over the next couple of quarters like a higher than 2%, a 2% plus growth rate, which is consistent with sort of what the consensus forecast was at that point. Even in early March, you can see we were still projecting pretty strong, like the 2% range growth rate for the world as a whole. So that is the green line, the light green. But then between early March and end of March, things basically turned on its head. And that is the orange line, where suddenly over like 3 weeks or so, there was a sharp deterioration, primarily caused by the lockdown. So one country after the other started shutting down, closing borders, and forcing activity to come to a standstill. So that's how quickly our forecast, our outlook of GDP growth for the global region as a whole deteriorated. And then come April and May, things have deteriorated even more, because just in the US, for example, we started getting these extremely high, historically high unemployment insurance claims, and similar for other countries. So the black line here is our latest, most up-to-date forecast for global GDP growth, percentage change from year ago. So we are expecting in 2020 Q2, so like this quarter, GDP growth to decline by -8%. And look at the difference from what we were saying in early January, which was a positive 2%. Next slide. So then we come to, so this was a quick thing. I just wanted to pick up where Brian left off about talking about the third wave global recession. It's pretty clear we are in a recession. What does this mean for credit unions? That's what we care about, the consequences. So what factors will determine credit union losses? And losses is just, I don't want to limit this to losses, but in general, credit unions, businesses. And if you can look at the points that I list, the first one is geo exposure, like where are you based? Like that is critical, like your local economy. How is your local economy going to do? So are you in California, or are you in Trinidad, Tobago, or Australia? So, that matters. And the chart I showed right at the beginning, provides some context to that. So first is the geo exposure. Second is membership base. So your members, are they like, what kind of industry are they concentrated in? Are they concentrated, do they work in an industry which is more exposed, more at risk, say travel and tourism, the accommodation industry, retail, more consumer facing industry, versus like professional services? If they can work from home, then in all likelihood, they will still keep their jobs. Whereas if your members come from a base which work in the hotel sector mostly, then you're more at risk, because then these people would have possibly lost their jobs temporarily, definitely, maybe even permanently. And then the third type is what kind of products are you supporting? So like, is it like mortgage, credit cards? What kind of loans are you making? Personal unsecured loans, indirect auto loans, because here there are the product nuances, and I'll talk a little bit about that. You know, where we saw during the last recession, 2009 recession, this payment hierarchy, like you sort of wanted to pay off your auto loans first before your credit card loans. So this payment hierarchy comes into question. And then the fourth thing, which complicates all of the previous analysis, is the lender assistance programs that many countries, almost every country, you know, has announced some sort of assistance program. So whether it is like forbearance, moratorium, like a 3-month moratorium on payment. So that makes it harder to estimate losses, because just because your member has lost his job doesn't mean that he will start defaulting on his loans, because these assistance programs sort of complicate the one-to-one historic relation that we have seen between, say, unemployment rate and delinquency rate. Next slide. So talking a bit more about geo exposure, because this is a global audience that we are talking to, I thought that was important to highlight. So we have done some very interesting analysis on trying to assign a COVID-19 exposure score to different, in this particular chart, I'm just showing different European countries, but we have done similar analysis just within the US, like which US states or metropolitan statistical areas are more at risk from the virus than others. So just focusing on this chart, essentially what we do is we estimate the risk of these various European countries based on the three factors that I'm showing on the right. So the first is the epidemic, the extent of the epidemic. So some countries are struggling with a more grave, severe epidemic than others, and that is an extremely important near-term, determinant of risk, simply because that is going to drive how long these government restrictions, stay-at-home orders, business closures, those will last. So if you are a country which is not suffering from a severe epidemic to begin with, you are already better off, because then presumably not every business has been asked to close and all. So there is still some sort of normality in your country. Whereas if you are in the midst of a severe outbreak, then possibly your borders have been closed and everyone is staying at home, there's a curfew. So for the short-term risk, the extent of the epidemic outbreak is very important. In the middle, then the next is more of a medium-term concern, is what is the industrial exposure? What is the industrial composition of this country? So, look at Spain, Belgium, Portugal. So by industry, I mean, is it manufacturing, construction, food and accommodation, professional services, health services? So we look at all of those. And then the final factor that we consider, so these are like risk factors. The final factor is a more long-term factor, and that is exposure to international tourism. So now what we are doing is we are assigning a score to every country in Europe for this particular example based on these three risk factors. So for example, like you might say that Italy ranks very high, as in very exposed, when it comes to the epidemiology, when it comes to the epidemic outbreak. Norway, not so much. Then what you are seeing in the chart is an average exposure score. So the blue scores on the right, so like Spain, Belgium, Portugal, they are much more at risk compared to Germany, Russia, France. This is after having considered the three factors that we show on the right. So this goes back to the first thing. So if you are a credit union, what drives your losses or your business? The first point is, where are you located? Your geographic base. Next slide. And so the same, we have done sort of a same analysis for within the US, because the US by itself is so heterogeneous. So the red spots, these are all metropolitan statistical areas. There are like 400 in the US. The red boxes are the regions which are more at risk. So you can think of 0 as the average risk, which is equivalent to the US average risk. Red and orange areas are overexposed to COVID-19. Looking at the factors that we talked about, as well as some other factors like demographics, density, like New York City, not only is it very risky by looking at the extent of the outbreak, but also the fact that people are packed together. And then places in South Florida, obviously because of the exposure to the tourism industry. So this, I think, is interesting. So again, if you are a credit union in the US, you are most likely you have a localized base. So you should pay attention to where you're located. For example, if you're in the middle of the country, then you're relatively better off because you're not as globally interconnected as the coasts are, and you are possibly not as densely packed in a densely packed city. Next slide. So that was about the geo, where you are located as a credit union. Then the next thing is just in terms of consumer demand, because credit unions mostly cater to consumers. In terms of consumer demand, our projection is that US consumers will demand less this year. And although this chart shows the forecast for US consumers, the story is the same, even internationally. And why will people demand less this year? Simply because they have less money. Remember the first chart where we showed about the global recession. So if there is a recession, it means people don't have jobs. And even the people who do have jobs are worried about keeping their jobs. So consumers will in general demand less all across the world. And you can see this play out in global oil prices. That's one of the reasons is the lack of demand. So the 3 lines here show some of the data, for example, retail sales, excluding autos, that's the light blue line. So you can see how that is going to dip. This is percentage change from year ago. And this the data is from a month back. So retail sales are going to drop. This is our forecast for the second half of this year. Mortgage originations, again, are going to drop because it's getting more and more difficult to buy a house because you don't want to open up your house to strangers, and neither do you want to go to other open houses and visit homes. And same thing for vehicle sales. And that is not surprising because you're just not driving anywhere. So even if you wanted a car, number one, the dealers are closed in most, at least in the US. They are doing online selling, but I'm not sure how that works exactly, unless you can take the car out for a test drive. So vehicle sales is going to drop this year, mortgage originations, as well as just in general retail sales. And because credit unions cater to this kind of a business, that has an immediate impact on loan growth and all, because people just don't want a loan. Next slide. So this is a very good chart which shows how in the US, the stay-at-home orders have limited vehicle use. This data is from the Department of Transportation, vehicle miles traveled per month, seasonally adjusted. And you can see the drop from the top of a cliff since the stay-at-home orders were instituted. This is just within the US, but again, I don't think the data would look very different for any other country because the same story there. So again, the point is, even if you wanted a car, people are just going to hold off. There isn't too many places to go in any case. There is a counter argument to this, and something that we have seen developing in China, where a counter argument is that people are now less reluctant to take public transportation because they don't want to sit and stand in a crowded place. So that is one argument, that the increase in vehicle demand might see a boost once these lockdowns are ended, but we'll have to see how much, whether it can offset this this lack of face-to-face meetings and all. That's something that remains to be seen. And then the next two charts I show, again, these two, this chart and the next one is specific to the US, and it shows what kind of gross loss rates, it's like credit card loss rates, we are expecting for this year. So you can see the x-axis is 2020 as well as next year for two asset classes. So this particular chart is showing credit card losses. There, the red line is credit card losses in the 2009-2010 average credit card losses during the last recession. That's the red line. It's there just so that you can benchmark, you can compare. And then the light blue line is what we are forecasting credit card losses will be now and next year. So they are almost going to peak at levels not too different from the Great Recession average. And the dark blue line, the something that says S3, is a downside outlook. So the light blue line is what we at Moody's think is our most likely outlook, which we call the baseline outlook. But given the uncertainty around any kind of forecast right now, the confidence bands around forecasts are just too wide right now. It's always prudent to think of what would happen in a more worse off scenario, in a more downside scenario. And that is the dark blue line. So the dark blue line is sort of like a 10% downside scenario. Under that scenario, which might transpire if the lockdowns go on longer and if many of what we think of as temporary furloughs get converted into permanent layoffs, simply because despite the government support, many small businesses have just failed or shut down. So then you might see credit card losses look something like the dark blue line, which is above the average of what we saw during the Great Recession, which is the red line. And the green line, which is the third line in the picture, is the reverse. It is what happens in an upside scenario. But I would focus more on the downside rather than on the upside right now, because that's where the risks are definitely weighted on the downside for now. Next slide, Andy. Yes, and the similar chart showing the exact same things, but this time for US auto loans. So the earlier chart was for credit cards. This chart is showing US auto loans, what we estimate gross losses to be. So this is before considering the recovery, the residual value of the auto. This is before we bake that into account. And the one difference between the credit card and auto you can see is in autos, even under our baseline or more optimistic forecast, you see that the losses are going to be much higher than what was in the 2009-10 average. And there are a couple of reasons for this. I should say that the underlying data for losses, like the credit for delinquencies and all of that, is coming from Credit Bureau in the US. So it's Equifax Credit Bureau. And of course, the economic forecasting is done by the Moody's models. But so if you're a credit card and you are specializing in auto loans, in the US, at least I know a lot of credit cards have indirect auto loans on their books. So that is something to be careful about because of all the various mortgages, for example, we don't deem those to be as risky relative to the other asset classes because of all the reforms that were done post the last recession. But autos is something that you should be careful about. Next slide. Great. So we started off by saying what are the things, what are the drivers that would impact credit union, businesses, and losses. And we said the first thing is it depends where you're based, which country, which city, which state, all of that. And we talked about those, how to figure out the relative risks of the different regions, whether in the world or within the United States. And then, of course, your membership base. Are they formed on, is it a group that depends on construction for their jobs, of the hotel industry? That makes a difference. And then the third is what kind of product lines are you exposed to? So is it autos, credit cards, student loans, mortgage? Because every product has its own idiosyncratic way of reacting to a recession. And then the final is the lender assistance program. So, at least in the US, the government has been very quick to step in with the CARES Act and the other stimulus programs to make sure that the recession, the brewing recession, doesn't translate into a financial crisis, into a systemic risk that happened in 2009 and 10. So various lenders have been given various sort of assistance, relief programs, and some of these are, most of these are temporary. And the idea being that some of these, the borrowers, many borrowers are they have a liquidity issue, but once the cash flows start coming again, then everything will be fine. So it's not an insolvency issue, it's a liquidity issue, because think of it as a small business which has been forced to shut down for the next 1 month while people stay at home. So it's a cash flow concern. So if only you can bridge the gap and help this person during this 1 month's time, then it'll be fine. So that will prevent this borrower from becoming insolvent, borrower or small business. But this works only if the shutdowns and everything are temporary. If they go on for longer, then there is a limit to the kind of assistance that any government internationally can provide. And that'll be the point where market forces take over and some businesses will be forced to shut, become delinquent, and be foreclosed. So why this is confusing is because we don't know the timelines yet. In the US, many of these programs are set to expire by the end of July, but we still don't know how much of businesses will be back up relative to what they were pre-pandemic by that time. And we'll get to know more as time goes on, but as of now, evaluating the efficacy of these assistance programs is hard, just because we don't have complete picture as of yet. So some of these losses may be temporary. If the shutdown is temporary, then some losses will be avoided, just like I said, by giving money to this restaurant owner who is in immediate need of liquidity, but once his restaurant opens, he's fine. But if his restaurant remains closed for 3 months, and even after it opens, he is allowed to operate only at 20% capacity, then that's a more permanent problem, and then there is no way to avoid losses at that point. Next slide, Andy. So again, because I said that we don't have enough data to evaluate how loss rates, like charge-off rates, how those will look like under these various kind of guidelines. So we've created some hypothetical 3 curves where the orange line is the status quo. So if nothing was done, here is how loss rates would look like. So they would rise sharply in the beginning of this year. That's when most of the stress is concentrated. And then towards the end of this year, they go down. And this is part of our economic thinking, that once the lockdowns ease, there will be an immediate rise in pent-up demand. But then eventually, demand will fall again, just unless we have a vaccine. So that's the idea. So that's why you see the hump kind of in the green line. That's status quo. And then the dark blue line is, what if the assistance looked like a pause? So it's basically saying, okay, you don't have to pay. You can just delay your loan payments for 3 months. So you have a 90-day moratorium. After the moratorium period is over, then the interest gets tacked onto the loan and it gets amortized, if it's a housing loan or something, and then you just keep on. It's like you were put to sleep, you wake up and you start making payments again, and it doesn't get counted as, like you missed your payment or anything. So that's the dark blue line. The lump payment, the light blue line, is one where after the moratorium period is over, you have to make a lump sum payment of all the money that you owed in those 3 months. After the period is over, you have to make the full payment to your lender. And there is no rule which says, so I think the biggest confusion is there is no exit strategy. People are not clear how they would continue to make payments after like that moratorium period is over. And that is why like these three hypothetical scenarios, from what I understand, it's based on lender to lender, like different lenders have their own rules. So that is just, one way of looking at it. Like the payment, at best, losses will be delayed. They won't go away, because forbearance is not like you don't have to pay anything. It's just you're being given more time. Next slide. Yeah, so then I think, and Andrew will talk more in details about this, but essentially what all this has done is it has created confusion in accounting. So if you go to the next slide, accounting has gotten complicated because of these three things that I list here. The first is the rapidly changing economic outlook. And we talked about this, especially in that chart where I showed how quickly our outlook has deteriorated since the beginning of the year. And why is this important? Because as per the new expected loss accounting rules, which is CECL in the United States and IFRS 9 in most other countries, as per those rules, you have to reserve losses in case of CECL for the lifetime, and for IFRS 9 for the lifetime for impaired loans. But those losses have to reflect the economic outlook. So that becomes really challenging when there is so much volatility associated with the economic outlook. So whatever you had reserved end of December and what you reserve end of March, there's a huge difference because of whatever happened in the economy during March. So people are struggling, so credit unions and also banks are struggling with loss reserve estimates, which are turning out to be extremely high because obviously the outlook has deteriorated in the first 3 months of this year, and not just high, extremely volatile. So there has to be a way of mitigating that volatility. So that is one area, one of the reasons why accounting is getting complicated, because of the economic outlook. The second reason are the assistance programs that I just talked about. So just because somebody, your member, has lost his job at the restaurant doesn't mean that he's going to default on his home payment, on the payment on his loans. Why? Because the government has this program which says that for the next 90 days, it's okay if you don't pay. So that now it's a challenge. So, your existing models don't have these policy features built in. So then you have to start making sort of qualitative overlays, looking at your membership, like, is your membership one that is going to be impacted by these government rules? Like, will they request for forbearance? If your membership is a high income category, it might not matter to them. So then it'll just be the way it was earlier. So those are some things you have to look, because that determines how much you reserve for losses and just your balance sheet. And then if this wasn't complicated enough, the third aspect is the relief provided by the international standard setting bodies. So they have come in with their own guidelines about regarding capital, and also in some cases delaying CECL and IFRS 9, so some of these programs. So they are trying to provide relief through various ways, through delaying some of the programs and then through other ways. So if you're thinking about accounting, you have to look at all these holistically. And sometimes they interact with each other in offsetting ways, and that's what causes some problems. So some guidance from national regulators in how they interpret the guidelines from the standard setting bodies to their individual members would be helpful, because I think that is where most of the confusion lies. And yeah, with that, Greg, I think we'll leave it to Andy.
Okay, thanks so much, Sohini. And just so you know, there is one question. If you want to take a look at the question panel, there's a gentleman with a question for you. And if you want to go ahead and answer that, or let me know, and we can answer it after the program is over here. But that was a great presentation, a lot of great information there. And I just want to remind people, if they have other questions, you can use the question panel and feel free to enter any questions that you do have. And this entire presentation, I know I already got asked that. Will it be shown later? It will be available on our YouTube channel at youtube.com/WOCCU, WOCCU. So let's turn it over to Andy Price now, who is our Senior Vice President of Advocacy, and he is going to talk a little bit more about those accounting issues and international standard setting bodies. Andy.
Thank you, and good to be here with you this morning or afternoon or evening, depending on where you're at. And thank you for that analysis, Sohini. I'm not sure if I'm depressed or happy or what now, but what's the more I learn, the more troubled I get. However, it's very interesting, because I think the analysis that you're putting forward, we can see that filtering through the international standard setting bodies, particularly your early slide, which kind of had that inverted cone on it showing we're in a crisis period. We're going to go through that, and then we're going to go through kind of a slow burn coming back out of it. You can see that filtering through the thinking of what's coming out of the international standard setting bodies on the accounting issues and the other regulatory relief that's coming down. So it's wonderful to transition to, I'm going to delve into what the international standard setting bodies are doing. So just to back up for our audience, international standard setting bodies are just that. They're international standards that these agencies like the Basel Committee, Financial Stability Board, International Accounting Standards bodies put out. A lot of the countries around from the world participate in those. The central banks or the prudential regulators participate in those. They are not direct laws for your particular country. Your country has to take those and adopt them. And a lot of times countries deviate from those. They don't adopt them wholesale all the time. And I want to point that out. So as you're thinking about your individual country, remember these aren't necessarily the Bible. However, they're highly influential, and a lot of countries will look to them for guidance as far as what to do. And it's interesting because on the one hand, I've never seen these international standard setting bodies act so quickly. It's amazing. And so I think the understanding that we're in a crisis, we're in a disruptive situation, is pushing this, and they're coming out with things very quickly. And what they're coming out with is really designed to address the stress that's going on with what's happening because of the crisis. And as you can see here, the Financial Stability Board, the language that they are using here is, look, make use of the flexibility within the standards to provide continued access to funding. Ensure that capital and liquidity resources for the financial system are available. So they're saying the direction that they're giving down to the national levels is, hey, be flexible, adjust, do what you can to help get us through the crisis. And this is very important. The Basel Committee as well, with your capital standards and some of the related accounting issues, are saying we're encouraging the use of flexibility to preserve the market. while still fostering both economic and financial stability. This is a direction that they are coming out with. And we're talking about accounting here, so I'm going to focus on those things that are coming out of the Basel Committee. But with respect to capital standards, we've seen the 1-year delay in the Basel III framework. Now, not every jurisdiction adopts Basel III necessarily for credit unions at a local level, but the risk-based approach that's in there is often adopted by many jurisdictions as well. But you see not only the 1-year delay, but the directions giving down to the national level is that members have the flexibility to undertake further measures if needed. That's given you at the local level, the green light to adopt things that can give regulatory relief to credit unions at the national level as well. So you're getting direction from your international standard setting bodies, provide regulatory relief and use the flexibility that's within your systems. This is great news for credit unions because this should allow your national level regulator to adopt those reliefs that will help credit unions out in the long run. And so the Basel Committee has adopted, I'm focusing just on the accounting issues today because that's what our focus of this webinar is. There are other things that they put out as well, and you can go to our website and look at, we have just about everything that's come out on our website if you need that resources. But with respect to the expected credit losses, they're telling you, that relief measures that are coming down, like public guarantees, they're giving you some relief as far as how you account for those as well. The transitional agreements, the IFRS 9 has the capital add-back provision that was a 5-year amortization that was to give relief to the accounting for that change in accounting that occurred over a period of time. They've now added in another 2-year capital add back in addition to that 5-year capital add back that's in there for those jurisdictions who are in the process of implementing that change, or perhaps if you haven't give that. So that's another area that you can get some capital relief from some of the accounting changes that are coming down. And then the capital treatment for non-performing loans, loans subject to moratorium, or that are past due, they're also giving you some relief about how you treat those from accountings, and that will help with the provisioning that you need to do for your allowance for your ALLL, allowance for loan and lease losses from doing that. So this is great. This is direction coming out from the Basel Committee that's providing you some specific relief. The problem with this now is, and Sohini alluded to this, this is where we really need national level regulators to give you some specific guidance on how you can deal with some of these programs that are coming down where you have loan moratoriums. What do I do during the moratorium period? Can I accrue interest? Can I capitalize the principal? How are you going to treat that and account that into your accounting standards? And a lot of confusion is coming out there, and we need national level regulators to give you some specific guidance on that. But the Basel Committee is already sitting out in the international standards ability to do with that and some flexibility and leeway to do that. Same with the International Accounting Standard setting body. They have also come out with very similar relief as far as the accounting treatment. So you're seeing multiple international standard setting bodies come out with simultaneous release. There's been delays in implementation. IFRS 9, we've seen that play through from the accounting standards. As CECL, you've seen the United States adopt another 1-year delay in the implementation of that. The statement that came out from the IASB is very good with respect to the expected credit losses, saying, look, it's difficult right now to assess the implications, so let's kind of hold off until we get a couple more months of analysis before you start having to include that in your analysis in your expected credit loss analyses there. So they're telling you kind of let's hold off for a second because that will give you some relief from the provisioning. Otherwise, if you start working all this stuff into the model while we're in a period of stress where everything is out of whack for now, it could wreak havoc on your accounting and your balance sheet. So they're saying, hey, let's take a little time before we start building in the analysis of there. And from around the world, we've seen various national regulators start to issue corresponding guidance. The European Banking Authority, the European Central Bank, the Prudential Regulation Authority in the United Kingdom, the Malaysia Accounting Standard Board, they've all issued guidance on this. In the United States, we've seen a delay in the implementation of CECL as well. So this is all great coming out to help you at the national level as well. And so I just want to walk you through some of the responses that we've seen from some of the national level prudential regulators as they start to implement some of these things. And these are things that we've seen from around the world, that we've seen some national level regulators implement. And I want to put this out there, so if in your jurisdiction you're having those conversations with your regulators, these are just some things that you might want to mention. You know, flexibility on meeting some of the capital standards, flexibility on including the crisis in your expected loss accounting. We've even seen the timeline for the definition of default be extended, as several jurisdictions have done this. In North Macedonia, for example, we've seen it go from 90 to 150 days. That gives you some relief from your provisioning. That's kind of a quick and easy way to give you some relief. So a loan that might otherwise be troubled during this period, you can wait a little while longer before you have to start including that in your allowance accounts and whatnot. The modifications, refinances, forbearances, we've seen some relief come down before you have to consider the loan that you might otherwise count as troubled. You know, a little bit of delay in having to account those for your allowance standpoint as well. And so those are really a lot of the accounting issues and what's coming down from the international regulatory bodies. On the next page, I have just, these go beyond accounting really, but these are some of the common things that we've seen credit unions go to the regulators and ask for relief on. One of the most common ones is a designation as essential, which gives you, the ability to operate at a national level. Actually have your employees show up at your branches and be able to run the place. If you're under a lockdown order, sometimes you're prohibited from traveling or going outside, so you can't actually get to your credit union. And being declared as essential allows you to continue to conduct your business. That's a big one that we've seen out there. We've even put some letters into some national level regulatory authorities to get credit unions to do that. Often they're not included in the definition. A financial institution, banks tend to get designated as essential, but credit unions get left out a lot of times for various reasons. So that's a big one that we've been out there. And these are on the list there for you to read through. Just a couple more items. If you're going to ask for regulatory relief, these are all on our website, and they kind of go beyond the accounting issues, but I just wanted to put that out there for your consideration. And with that, I think we can take it to questions. Here's my contact information. If you have any questions, please feel free to reach out to me. I'll respond to you as quickly as I can. Sohini's contact information as well. And then there's all of our information where you can find a lot of our COVID resources as well. And I'll give you one more benefit. So if you're like me and you're isolated and you're in your home and you're having trouble sleeping, read some of these disclaimers here. I promise you they will put you to sleep instantly. So that's another benefit for you. And with that, I'm going to turn it back over to Greg, because I think we have some questions that are coming through.
Yeah, we do have a few, and Sohini's been good enough to hang out and answer a few of these for you guys. So Vincent Murphy has a question. He says, excellent presentation from Sohini. Do you have any market intelligence specific to the Republic of Ireland? Many thanks.
Yeah, so in terms of market intelligence, do you mean like the outlook of the economy? That we definitely do. And, like we do analytics on a bunch of countries, like 100 or so countries across the world. So I can definitely reach out back to you with some stuff specifically on Ireland. And yeah, if you just share your contact information, I don't remember from the top of my head, but definitely we have that information.
Okay, another question from Ireland, and this may be for anybody, either you or Andy or Brian maybe. Mm-hmm. It says, in Ireland we use FRS 102 and the incurred loss as opposed to expected loss approach. How do you think the pandemic will impact on that?
I can start off. So the main difference between incurred loss and expected loss is the incurred loss is mostly current conditions. Right. So that's what you have to keep in mind. So the pandemic is, so the one good thing about incurred loss is there is possibly less volatility because you're not having to worry about the lifetime, how the economy is going to look over the lifetime of your loan. So if you have a longer term loan, like a home loan, then that's longer. That said, even the current conditions are changing, by the blink of an eye. So that, I think, and Andy can correct me if I'm wrong, but between the incurred loss and expected, that third piece, which is the economic outlook. So there is the historical consideration, the current conditions, and then the third piece, which is the future outlook. In incurred loss, the future outlook is not as much important as it is in the expected loss. Andy, do you agree?
Yeah, no, I do agree. And then the other thing that I'll add on is in Northern Ireland, I don't remember the exact code site for the accounting that you use, but you guys are regulated out of the Prudential Regulatory Authority out of England. Your IFRS standard is actually based on IFRS 9 for SMEs, which is a much lighter touch than your traditional IFRS 9, which a lot of other jurisdictions are having to implement. And so you have the advantage of already having a lighter touch for your IFRS 9 calculation as well. So I just wanted to add that on as an addition. But yes, I agree with Sohini's analysis.
Okay, I'm gonna have these guys answer one more. We've got quite a few questions now. What I'm going to do is have them answer one more, and then anybody else, I want to have these questions sent to both Sohini and Andy, and they can perhaps answer them offline via email. The last question I'm going to ask is Sohini. The question is, Sohini, what made you show that auto loans at baseline already showing losses in the pre-pandemic era, and why are auto loan losses not sensitive to the downturn? Let me see if I can get this, compared to credit card loss trends, or not as sensitive to the downturn compared to credit card loss trends?
So auto loans had started to, deteriorate in terms of like credit quality, and that is something we were seeing in the data even pre-pandemic. It's just how the data was showing, and this is just US specific. So in terms of standards, lending standards, and you were seeing like one thing, you will notice that in the US, loans are now given for 84 months. So the duration of auto loans has increased, and it's now 84 months long. So you have like enough time to make your payment, but the longer the loan term is, the longer the possibility that you will eventually not be able to pay. So that was one of the critical things that we were noticing in auto loans, which is like a change overall in the structure. And then of course the pandemic hits. In terms of not as sensitive, that is more to do with how this particular crisis looks like, rather than the 2008-9 crisis. I mean, they will definitely both be sensitive, but a credit card is unsecured. That is something to keep in mind too. So people start defaulting, it's unsecured. Auto is not. And in terms of how much you need an auto, that depends, because if the logic we were going by, that you don't want to get on a public transport again. Imagine somebody living in New York City now moves to the suburb because they don't want to stay packed with other people, so then they have to buy a car and keep making payments on that car. So there are these various nuances, but we do have some assumptions.
Okay. Well, I want to thank everybody who joined us today. Really appreciate your time. I hope you found it valuable. Sohini, I know Andy and I were both thrilled to have you join us today as well, and Brian also. Andy, do you have any last words for us?
No, just thank you to everybody for attending, and really my offer to, if you need any help at your national level, please feel free to reach out. It's what we do here at WOCU, and appreciate you attending today. And I'm very grateful to Sohini for presenting today. It's every time you speak, it's wonderful. And although I'm very concerned now with what you're saying, I think we're much better off for having the information. So we appreciate it.
Yeah. Yeah, invite me during when we are in better economic times. So then I'll have a rosier message. But for the attendees, thank you so much for attending. And my contact information, my phone and my email ID was on the slide that Andy showed. So feel free to just send me a note if you have any questions. And I believe we will be sharing the slide as well as the replay on YouTube.
We will be,
thank
and
you, and stay safe.
Thanks, Sohini. And I'll forward the questions that were not answered on to both Andy and Sohini. And yes, we will have the video of this presentation up on YouTube later today. Thanks so much, everyone.
Thank you.